Hey learners, welcome to Trade Tactics. In today's video, I'll explain how you can use the RSI indicator to make high probability trades. RSI is a leading indicator, standing for Relative Strength Index, and it's an oscillator indicator. An oscillator is an indicator that moves between 0 and 100 and cannot go outside this range. When you apply the RSI indicator on a chart, it will look like this. You'll see a single line moving between 0 and 100. This line is created from the average of the closing prices of the previous 14 candles. You'll also see two levels here, one at 70 and the other at 30. When the RSI is above 70, it indicates that the market is overbought. This means the stock price is trading above its intrinsic or fair price, the price it ideally should be. When the market is overbought, it means the stock is trading at a higher price than it should be. But this doesn't necessarily mean the stock is too expensive and should be sold. Similarly, if the RSI is below 30, it indicates the market is oversold. This means the stock is trading below its intrinsic price. But again, this doesn't necessarily mean the stock is too cheap and should be bought. Next, we have a highlighted range between 70 and 30, known as the no trading zone. If the RSI is between 70 and 30, it suggests that no trade should be taken, as the market might be sideways, or there might not be enough confirmation for a trade. One of the most common mistakes beginners make is selling as soon as the RSI hits the overbought level, or buying as soon as it hits the oversold level. But this is an incorrect way to use RSI. If the market is in a strong trend, the RSI may stay continuously in the overbought or oversold region. When a stock crosses the 70 level, it means the stock is just starting to become overbought, not that it already is. Similarly, when the RSI crosses the 30 level, it means the stock price is just beginning to be oversold, not that it already is. So how can we use the RSI to make profitable trades? The best way is to combine the RSI with price action. When the RSI crosses above the 70 level and then falls, it often forms a red candle. If the next day's red candle breaks the low of the previous candle, you can sell here. Likewise, when the RSI crosses below the 30 level and then rises, it usually forms a green candle. If the next candle is also green and breaks the high of the previous candle, you can buy here. In our next strategy, we'll use the Bollinger Bands along with the RSI. Here, Bollinger Bands will be our main indicator to provide buy and sell signals. I'll go to my trading platform and make some changes in the RSI settings, setting the upper band to 60 and the lower band to 40, and using a 15-minute time frame. In this strategy, the time frame is very important. When any candle touches the upper band, that is our first entry signal. Next, check if the RSI is above 60 at that time. If it is, this is our second signal. And third, check if the next candle breaks the high of the previous candle. If the next candle breaks the previous candle's high, you can buy here. If all three conditions are met, you can buy. Similarly, if any candle touches the lower band, that's our first signal. Next, check if the RSI is below 40 at that time. If it is, that's our second signal. And third, check if the next candle breaks the low of the previous candle. If the next candle breaks the previous candle's low, you can sell here. If all three conditions are met, you can sell. Hopefully, you gained some information from this video. If you found it informative, be sure to like the video and subscribe to the channel. See you in the next video, and best of luck with your stocks journey.